Welcome, everyone. This is our January 2025 market update. Happy New Year.
Happy New Year, everybody.
I'm in the studio today with Jesse Hamilton.
Hey, everybody.
I'm Mark Trice.
Sorry, you can't see our faces. We had a slight camera malfunction, but you know what we look like, and hopefully you don't need to see us.
Yeah. So, Jesse, this was kind of a lot of things went on this last year, a lot of things that are interesting to discuss, and we're going to jump into that
Yeah,
here in just a second.
we're gonna look at our indexes as normal, but this time we're gonna look at the entire year, so 12-month trailing on all of our main indexes. But then we'll make our comments on the markets, and of course we'll talk about the economy. I want to do a deep dive also, Mark, today on the interest rate situation and
Yeah.
the timeline of what we've been working with over the past year. We'll get into details about how these popular stock indexes that a lot of people follow, they might not be the best indicator of how strong the markets are right now. We are, of course, enjoying the benefits of this bullish market, but it might not be as roaring as the media makes it seem.
That's right. That's right. Because the headlines you'll see are S&P has record year.
Yeah. And
And let's just go ahead and jump into that. So we'll start with this cap weighted. The S&P 500 is an index. You can't really buy it. You can go to individual fund providers and ETF providers and find something that mirrors this. But this consists of the largest 500 companies by capitalization, with the larger companies having a large effect on the index.
yeah, so the general trend over the year was up, and the index closed the year plus 23.31%. You can see it did experience some volatility in April and then into July and August. In the middle of the year, you can see a little bit of a pullback there. So that mid-year pullback that we're talking about in July and August maxed out at 9.71% negative from peak to trough. So that's just a few basis points away from a technical correction.
Hmm.
And of course, corrections are very normal and even healthy in a market like this. So we expect to see that. But almost a 10% swing in July, which is always shocking to some investors who are not comfortable or prepared for the markets to swing that much, but it's
Hmm.
pretty normal.
Absolutely. So I'm trying to get a different color here on the arrow, but I can't. So that's what happened there. So we do see that in the month of December, the last 2 weeks of December, which we'll get into in just a minute, the market did pull back. Not a correction though.
Hmm.
The Russell index we'll talk about is in a correction phase right now, but the S&P continues to go forward.
Can you show your arrow there at the
Yeah.
first week of November? And of course, how the election results spiked up the market like
Yep.
5 or 6% in a number of days.
But you can see is that the year closed pretty much where the impact of the election had pulled back.
Right.
So we had this gap here on the really the day after the election. That would be the 6th, right?
Yeah.
And and it pretty much kind of closed there for the year. And that was a lot of volatility through there. The market pulled back in a period here after the Federal Reserve meeting in mid-December.
That's
So
right.
I think one of the things we have to talk about here with this index is that 70% of the entire gain on the index was encompassed by just 7 to 10 companies.
Yeah, and we saw that in 2023 as well. It's these huge companies that carry so much weight in the index and they're winning. And if you don't own those exact companies, you're not winning because the rest of the
Well, you're
stocks.
winning, but you're not winning as much as the Magnificent Seven.
That's right.
And so that's what to remember. We're going to look at some additional indexes, a moderate index here in just a moment.
Right.
But so, okay, so we had a good year in the indexes, right?
Yeah.
Okay,
So you had a good year. If all you were holding in your portfolio was large cap weighted stocks,
right.
you did all right.
And you're thinking, wow, I'm a genius.
Yeah.
And the reality is that most people are actually owning a much more diversified portfolio. You did not experience that type of growth
Yeah.
last year.
So
What about the
here's
NASDAQ?
the NASDAQ is similar to the S&P, but even more volatile from time to time. Another cap weighted index focusing on technology. and doesn't include financial companies. So you can see the trend also here was up. Mark, the index closed about 28% for the year and experienced similar timeline for volatility in April and July and August. But like I said, it tends to be more volatile. So that pullback that we're showing on the screen in July and August was actually right below 16% pullback. That's a full-blown correction. And I mean, in the NASDAQ, that's still considered normal because of how volatile it is. But 16% in a matter of a month if you're holding this index.
So that'd be kind of scary here. And we
Mhm.
had another pullback toward the end of August, 1st of September. What I was looking at here, Jesse, was something a little interesting. I don't want to draw on here because it'll mess up the future charts and things, but we ended the year fairly close to where we started July.
Yeah, we peaked.
And so we had a lot of volatility in there. There's still a lot of things that are uncertain about the economy, and the Nasdaq's kind of showing symptoms of that.
Mhm.
So what about the Russell 2000, Jesse?
Yeah, this is our small cap index. 2,000 of the smaller companies, still, hundreds of millions of dollars and billion-dollar companies, so not small, but comparably small. This trend was a little bit more sideways than the large caps that we looked at throughout the year. The index did close a positive 10.09%, but you can see just the extreme volatility just rapidly. Well, we moved sideways for 6 months and then we had just rapid volatility over and over again, back and forth. And then in the last 45 days, Mark, we've pulled back over 11%, which is a correction.
So we basically pulled back to where it was before the election, November 5th election.
Essentially, yes.
Yeah, and so that's pretty alarming there with that. That just telling you that well, we know what that is, and we're going to get into that in just a minute. But it's telling you that the market did not like some of the interest rate conversations
Hmm.
that were had in mid-December. Long-term treasuries,
Yeah, this is our long-term treasury bond index that we cover. It was minus 11.04. This is the one that nobody wants to talk about, but you
right?
probably have some in your portfolio if you're not being proactive about it. The index did rise through the middle of September, and that has to do with the interest rate cuts and the excitement around there. And then it fell back down, and it fell 14.39% just in the last quarter.
So we've had now the third year in a row where long-term treasuries have lost money.
Right.
And so this year is down minus 11. You remember in 22, the index was down minus 45% at one point. Uh, Most people that have a diversified portfolio are holding these long-term treasuries in as part of their portfolio. And that's concerning um, because you're not performing as well as those large cap indexes because of these bonds.
Hmm.
And you need to know what to do with that. But yeah, so for the third year in a row, bonds have lost money. I don't think that's happened before, except maybe in the 1970s. I don't remember that happening before. I'll have to go back and look at our data later on. And then lastly, Jesse, we wanted to talk about the moderate index. We have a moderate index that kind of mirrors a 60-40 portfolio,
Yeah.
60% stocks, 40% bonds.
Yeah, we use this as a comparison tool and nothing else really, just to look at what a moderate investor might perform in the market. And it's not a guaranteed comparison here, but an investor who might want to take a moderate amount of risk through a somewhat balanced portfolio could expect relatively similar to this. This index closed plus 4.65% for the year, and that's shockingly different than what you hear on the news of the S&P at 23%.
That's right. And the Nasdaq at 28.
Yeah.
So, that's why when you look at your statements and things for the end of the year, you may be thinking, "Hey, wait, what?" And because I can almost, well, with few exceptions do we find people, especially their 401k, that are invested in something other than a target date index. And if you're nearing retirement, you're in a balanced or even more conservative portfolio than the large cap growth indexes.
I
So
think a lot of people get frustrated here, Mark, because 4.65 is nearing the range of what you can get in a fixed guaranteed rate
yes,
environment these days.
yes.
and they say, "Why am I working so hard in the market if I can just go to the bank?"
That's right. That's
And so
right.
that
That's
well,
a very myopic view,
yes, it is.
and shouldn't be necessarily followed unless you need some type of short duration CDs or things like that. But we're seeing Treasury bills are performing that well as well. So
Hmm.
okay, um, we have to give our disclaimer that we always give.
You don't have your Spanish music
No, I
ready to
don't have
go.
Spanish Flea there ready to go. Oops, I gave away my pointer. I think we need the pointer here.
Yeah.
So let's do that. There we go. All right, so we'll move on here. Hopefully all of you read all that very thoroughly. Okay, so let's go back and look at this. We've been including this because we wanted to point out the difference in the S&P and the Russell Small Cap Index. This
The
is going back 3 years.
Yeah, the S&P is in the blue or the green and red color, and then the small caps are in blue. And you can see in 2022, the blue line was actually above and outperforming the large caps. And then we can see what happened and has happened since. But what's most interesting is what happened in November. And you can see the blue line approached the green and red line, and then it fell back down.
Yeah. And then so small caps a weak performance in the month of November and December, which is those two indexes, even though the S&P pulled back in the last 3 weeks, those indexes are diverging.
Hmm.
And that's a challenge. That's something we have to watch for as far as risk that's on the playing field in the market. And we know that, this is typically a volatile time of the year. January and February tend to see periods of increased volatility in the spring. Now, it does not mean the S&P is going to be to rise in the fall or whatever. It just means that there's, based on historical data, the summer months usually are typically milder when it comes to volatility, and then the fall tends to pick up intensity in the volatility. But
Hmm.
early in the year, typically is a typical year because um,
You mean it gets more volatile
it
as the
gets more
spring goes
volatile
on?
as the spring goes on. But we also, every time it's different. The pundits on the news will say, well, we're going to go into a period of volatility. We don't know.
Hmm.
We can't predict the future. We don't have a crystal ball. I think one of the things we were expecting, especially after the election, was that we'd have a strong Santa Claus rally, right? That's usually the last 2 weeks of December. Historically, if it's an up year during that time, that bodes well for the following year. We didn't see that this year. In fact, we there was very little rally at all. It was more of a whimper,
Yeah.
if you will, and Santa didn't bring us good results at the end of the year. A lot more volatility typically than we normally see this time of year. But
Hmm.
we watch for the volatility. That's going to happen. That's going to affect your portfolio.
So I updated this chart. This is that same moderate index that we talked about, and it kind of tells the story of how we got to where we are right now. So let's click through here and kind of see what happens. The first is, of course, COVID, where the markets dropped very quickly, almost in a span of weeks, and then it recovered almost as quickly.
Yeah.
And then we had 2021 where we had all this stimulus and rally that brought the markets up, and the indexes loved it because there's getting money pumped into the
Do
system.
you remember times when and that was a big thing for like Robinhood and
Uh-huh.
everybody was a brilliant investor and things like
Yes.
that? And oh, oops, that
If
didn't
you bought a
happen.
meme stock and made a bunch of money, you were a genius investor.
Yeah, you're stupid. But anyway, and in most cases unlucky because
Yeah.
most people did not make money in those things.
Hmm. And then next up is the 2022 bear market, where the sugar high fell off and inflation hit a 40-year high in June at over 7%. The Fed stepped in to bring down that inflation by raising interest rates at the fastest pace in history, and the S&P fell over 22% and long-term bonds over 40%.
Yeah.
Then 23, we moved sideways and had some extreme volatility up and down, and then closed out the year with a little bit of a rally, and we move into 24. And now we have, of course, the AI situation and the Mag 7 that Mark talked about earlier, those big companies that are using AI. And there is a lot of value being created there. We're not saying it's all fluff, but investors got very excited.
I think what's interesting here is, do I need to click again?
No,
Okay.
here's the end of
Yeah.
2024.
I think the interesting here is even though how we've had a rise on this index in 2024, we're still not back to where we were at the end of 21.
Yeah, I've got a red line here that shows the end. One more click. That shows the year-end price of
Yes.
this
So
index.
with this index, this modern index, which a lot of our listeners own in their 401ks and things, we're still not back to where we were in 2021. We're now into 2025. So 4 years, we're still trying to recover from those two events post-COVID.
Hmm.
So I think that's something that's very telling that investors need to be aware of. Oh, I forgot to tell people, send your questions to 254-282-0495. And of course, I left my phone in the office when we came down to study, or to broadcast. So
I'll
I'll have
keep
to
an eye on
look
it.
and see this, but we'll try to get back with you on the program. If not, we'll get back with you within 24 hours. But let's talk some about the economy and the interest rate environment. And I think that'll give us some perspective, Jesse.
Yeah, I wanted to do a deep dive on the interest rate situation because so many of you, it's tied directly to your daily life. In December, the latest cut approved by 11 of the 12 voting members lowered the Fed funds rate to 4.25 to 4.5, which is a 2-year low. You can see that little drop off at the end of the chart to show the quarter point that just happened. And this is the third reduction in a row for the year for 2024, and that leaves us a full 1 percentage point below the high.
Okay, so rates have come down a little bit, but they're still at what might be for many all-time highs. Now it's
Mhm.
not. I mean, interest rates have been higher in the past, but typically when we see this, when the Fed begins to cut rates, if you go back to 2002, and then you look at a 2007 and 8, you typically have a period of a recession afterwards.
Mhm.
Now, there's a couple other things here. We go back to 2020, but that was induced, COVID induced. Well, it was government induced as a response to COVID. So you have mild recessions in there. But if history holds course as it's done in the past, then we should expect to have a mild recession here sometime soon. It's a little confusing because the economy seems so strong.
Right.
The reality is, when it comes to production and manufacturing, we probably have been in a recession for some time now. But you're not going to see the government announce that anytime soon.
Mhm. The Fed's really in a balancing act, and they're playing with fire because this is
Yeah.
this is our daily life. This is our financial lives. So they're on a balance beam playing with fire when they're trying to figure this out. But they want to prevent aggressive rate increases from the past 2 years. They want to, without unnecessarily slowing the economy, which is how it affects you and I.
So core prices have started creeping up again.
Yes.
And that's something we have to watch because it may impact the Fed when they meet. I can't remember the meeting in January or the meeting the 1st of February. I can't remember exactly. But it's coming up
I'm
here
not sure.
soon in the new year. Will they continue to cut rates? And there's some indication, and we'll show you here in just a second, there is some indication that perhaps they're going to slow this cutting down, if
Mhm.
not perhaps raising interest rates again. This is the dot plot that was released at the December rate cut announcement. The dot plot is a forecast of the voting members of the Fed on where they see interest rates in the future.
It doesn't really mean anything other than a prediction of what the voters think is going to happen.
See, now here, this is 2024. Most of the people see that we were going to be somewhere above 4% here. Each dot represents a voting member. Let's go into early 2025. Look at the range that members see. One person sees keeping it the same. Some members say we're going to cut them. Some of them say we're going to cut deeply. And then you see that really that range kind of stay flat for the next 2 or 3 years.
And that's what the market did not like.
Yeah, they did not like that. They wanted to see those cuts continue all throughout 2025 and into 2026. The markets were banking on a fact that the interest rates would do like they've done in the past and cut deeply to stimulate the economy.
Mhm.
So that is not probably going to happen in the same way. Now, we know that the new administration's putting a lot of pressure on the Fed. They are they are supposed to be a apolitical organization. In other words, they're not adherent to or responsible to any particular administration. We'll see the new administration probably pontificate quite a bit, trying to influence that. In the end, it's up to the Fed to decide these things, and they're doing it based on data that they receive. And oftentimes that data is behind. It's a looking back.
Yeah.
The damage is done or the need for a change is well past. And so they're always reacting to data, not looking very proactively. So this is an interesting slide, Jesse.
Yeah, this is the St. Louis Fed, the Fred website, if you want to look it up yourself. You can see the Fed funds rate since 2022, and it compares how much they've cut versus how much they raised,
So this is going back to really early 2022 when they first started raising interest rates.
which is zero. The bottom chart is zero.
Almost, yeah, absolutely. I'm circling here with the pointer. And then when they raised rates rather rapidly throughout 2022, they stayed pretty much level for a while through the end of 23 into early 24, and then they started cutting rates. But look from where we started to where we are now, rates are still much higher than they were in 22 at the
And
beginning of
borrowers
22.
and investors got so used to that 0% money that you could go get a 2 or 3% mortgage on.
Yeah, and people got used to that cheap money, and now it's difficult to find a mortgage for less than 7%. So this is a more expanded view of the Fed fund rate
Essentially the same chart.
since 1973. So we went all the way back to 1973. It helps us gain a little bit of perspective on where we are today versus where we have been in the past. And
We really want to avoid what happened in the late 70s, early
right,
80s.
because everybody remembers the mid 70s, late 70s when interest rates were high. Federal funds rate at some point in the early 80s, just after Reagan got elected, was in the close to 20%.
Wow.
And for someone that was growing up and having parents that got stuck with two mortgages because houses were not moving, and as a football coach, you have to move from time to time. And so that was a burden on my family, I remember. Somehow they got through that period. Rates began to fall in the early 80s and kind of have maintained this range since the mid 90s of somewhere between 0 and that 5.5%. So this is really interesting, kind of gives you perspective. And for the younger listeners that are watching this, hey, things are not as near as bad as they have been in the past. So I don't know if we need to send a thank you note to Uncle Jerome, the Fed president. I don't think we do, but
I don't think he'd write
it
back.
just puts it in perspective. It'd be cool if he did. Yeah. All right. Now we've been talking about the yield curve for some time. We've been talking about it really since what, 2022, 20,
Mhm.
yeah.
So this is the updated, well, as of the end of December, there's a few more days in, but the curve is changing. And on my next slide, I'll show you what it was in the middle of June. But staying here for a second, you can kind of see, we want to see a sort of a hockey stick formation where
Yeah,
it's low on the left and kind of spikes up on the right,
right.
because that means long-term money has a higher rate than short-term money, which is the way it's supposed to be. But we were backwards for almost 3 years.
Let's look at that. We'll show you just to compare.
Yeah, here's the chart from June.
So this is just June of this year before they started cutting rates, right?
Yeah.
Yeah. So you can see the short-term rates over here are
Five and
much
a half.
higher, a full percentage point above where they are now. And then the long-term rates were much lower, still in the fours.
Hmm.
And so that has changed. Let me go back and go back. Here's where we are now. This was right before Christmas. and then where we were. And so that curve has now re-inverted to look something more similar to what we'd like to see in a healthy economy.
Yeah, it's encouraging, but historically, that has never happened without a recession.
Without a recession or a lot of volatility in the market.
Hmm.
So what we're saying, folks, is that hey, we're probably going to we're going to be going into quite a volatile period. Let's talk about housing.
Yeah, this is on the minds of a lot of our listeners and clients these days because they want to either upgrade their home or move, and they're just waiting on the day that they can get a better mortgage rate. We talked about historically, they're actually comparably low, but they're still high. New single family homes, so brand new homes built increased 5.9% in November, which is a very positive number coming off of a lot of the carnage in the last 18
Yeah,
months.
but it's not, maybe not as strong as the economists expected.
Hmm.
And new home sales kind of appear to be stuck in low gear, okay, running at a set pace similar to 2019. The biggest question for the housing market, Jesse, is whether the recent string of rate cuts from the Fed over the last 6 months would be enough to get homeowners off the fence and into the housing market. So,
But
and thus resulting in a new upward trend in house sales.
but we just looked at that dot plot, and the expected cut for this year is 2 1/4 points. So that would only bring the mortgage rate down a couple of basis points.
That's right. That's right. So we'll have to see if people are just, because people are waiting is like, oh, they're so used to the cheap money, they're going to wait.
Hmm.
It also means like if I am a homeowner that has a mortgage and I want to buy a new home or upgrade or down, upsize or downsize, I've got to pay more money. I'm sitting on, a 2.98% mortgage and I'm like, that's cheap money. I don't know if I want to move.
That's right. And I know quite a lot of people who are looking to downsize and they can't because even they want to get a mortgage on a smaller home and the rates are so high that it doesn't make financial sense at all.
Right. Now, the good news for potential buyers is that the median sales price for new homes is down 6.3% in the past year.
Hmm.
That's good. That means that the builders and things are realizing that the traffic is not moving as quickly as it was in the past, and that means that they're having to discount prices from where they were in order to attract people because there's a relationship here. There's a relationship between the interest rate and the price. And so we're starting to see a little bit of downward pressure on median prices for new homes.
The builders still want to make money too.
That's right.
So here's the existing homes,
Okay.
which increased 4.8% in November.
Yep.
That actually is the second month in a row that that rose. So that's
That's good.
positive.
Yep.
Buyers are coming in, but sales activity is still subdued. The 4.15 million pace of November is below the roughly 5.2 average. So if you annualize the rate, we're about a million homes under the average
Of sales of
of
existing
sales
homes. Yeah.
pre-COVID.
So slow down definitely. You're probably seeing that in your neighborhoods wherever you're living to see that turnover happen a little bit
Mhm.
slower.
But the median price did decline, same here, to 406,000, and it's up 4.7% over a year ago, which is, I guess, higher than general inflation, but good for homeowners.
Yeah.
Prices are going up.
Good news. So there's a lot of conflicting data still, right? Market's rebounding generally. Um, it's hard to predict the future. No one can predict the future, but it's really hard when you have conflicting economic data.
Yeah, we
So
we
what does it
try
all
to
mean?
try to be positive here with also bringing a reality check for those of you that only listen to the media, right?
Yeah, because we don't have a crystal ball, neither does the media. No one on MSNBC has a crystal ball. No one on Bloomberg does. And it's interesting to watch the financial media shows as well because they bring
Hmm.
in sponsors. I don't know if you knew this. You can go appear, Jesse. We can go appear on Bloomberg
Yeah, but we don't
and
run
be a
a
guest.
billion-dollar mutual fund.
No, but you can actually pay, and these
Yeah.
funds pay to get appearances on
Yep.
these news shows.
Yes, they do.
And so, we're the average layperson. We're watching the news program, and they have, ABC fund, a manager that comes on there. It's possible that he actually paid to get an appearance.
Hmm.
What has ABC fund done that's so special? Well, nothing.
But they can spin it like they're doing amazing things.
That's right. That's right. So be wary of anything you hear on the news.
Yep.
But right now we're still juggling lots of incomplete and conflicting economic data and market data that makes it a little more difficult to predict the future.
Yeah. Here's a little nod to our healthcare friends if you're listening, but carrying a lot of these over from last month, these are the things that are on people's mind. The differences here are, of course, the Fed rate cut in December. That's a new piece. Revised expectations, and in my opinion, worse expectations for 2025 rate cuts. Everything else here is the same. Bond indexes are struggling. Credit card debt is high, historically high. And then, of course, there at the very bottom, we're inaugurating a new administration. And that has
Yes.
people, some people worried, some people expect volatility. We'll see what happens.
Right. All right. So once again, we don't make predictions. We don't give our political opinions or anything on that, but that will bring change, and we'll have to see what that means. So the solution that everybody wants to know, we're adapting to this dramatic shift, and it's one reason why you choose to manage your investments with us. As the indexes continue to rise, we'll take advantage of those opportunities in the market. And we'll also try to help people understand and navigate the bond market with a caution. So as always, we encourage listeners not to make decisions on investments based on headlines or a fear that you have, because that fear is probably not real. It seems like it because, once again, watching the financial media or any media, they get you to watch by making you scared.
Yeah, they make you feel an emotion, and people act on emotion. That's how our natural tendencies go.
But we believe the U.S. future is bright, and the economy will continue to operate no matter who gets elected or who's in office, recession or not. We've seen this before. And this will be telling here in the next several months, and we hope you continue to tune in and listen. But
we always throw this in at the end. If you're struggling with your 401k, if you don't know what's going on, you don't know the funds in your plan, give us a call. We'd love to help you out with that. Even just give you some high-level advice and send you on your way. We would love to help you, and that's a large portion of people's savings usually.
And you may be invested exactly where you need to be.
Yeah.
But it's good to have a second opinion to look at that.
We have some great tools for
We
that.
do. We have a couple different tools that you can subscribe to that will help you rebalance the portfolio when you need to. Okay.
Well, it's 2025.
Happy New Year again,
Happy
folks.
New Year. Our plan here hasn't changed. Be sure to check your statements. Don't be afraid of what happened last year, whether your statement has good or bad news on it. And of course, talk to a professional and continue to educate yourself. I'm glad you've joined us today. I hope you learned something. That's kind of our goal, is to educate people and teach them.
You don't want to invest for the short run.
Right.
That's why we were saying about the interest rates. Don't invest, don't put your money in CDs because you think you can do better than stocks. Historically, over time, stocks and bonds have done much better than deposit instruments at banks. Right now, people are still seeing that they're getting a decent return for that. We saw those interest rates fall throughout the end of the year, and at best, we can see really short duration CDs that are paying anything beyond a year is not paying much at all.
Right.
But talk to your financial professional, visit with them to make sure you understand what's going on in your portfolio. If you need someone to talk to about that, we'd be happy to visit with you on those things. You can give us a call. You can schedule a consultation using our Calendly link on here. Send us an email anytime at info@clearvistafinancial.com. We'll be glad to talk to you. Those meetings are complimentary, of course, just to get to know you and get some help. So thank you for listening in today. Happy New Year, and we wish you the best in 2025.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.